In this module we introduce the whole topic of partial interests. Partial interests for the valuer is probably one of the most interesting and powerful aspects of the advanced valuation area. Partial interests is the recognition that in some cases the value of different interests in land can be separated out and independently owned by different people. For instance, when a landowner leases his property to a tenant, the tenant acquires the property rights to be able to call that property his for the length of the lease. And depending on what rent is struck, the tenant may end up benefiting. For instance, if we're talking about a valuable office or industrial property and the rent is set at, let's say, some nominal price, what we often call a peppercorn rent, let's say a rent of $1 per year, the tenant actually benefits by having free access to valuable property for virtually nil rent. And on the other hand, the property owner is basically giving away their property for the length of the lease. Why would somebody do this? Well, that's a fairly extreme example. But on occasions, peppercorn rents are used in cases where property rights are intended to be transferred, at least temporarily. From the point of view of the owner, the value of the property is, or at least their interest in the property, is the value of the property once they get it back, which they may have to wait for some time to do. So if I own a property maybe worth $1 million and I lease it to you on $1 a year, I might choose to ignore the $1 a year. It's hardly worth the postage of our communications. But if I lease that to you, I still know that at some point in the future I'm going to get my $1 million property back. Let's say that's in 10 years' time. Well, the value of the property to me is not $1 million because I have to wait for 10 years to get it. And so my partial interest in the land is the promise of having a $1 million property that will be back in my control in 10 years' time. And very simply, that's the present value of $1 million. On the other hand, the tenant has the value of the property for that 10 years. What's the value to them? Well, it's the present value of that set of rents off over the next 10 years. And when we apply discounting and so on to it, what we will find is that that 10 years of free rent will actually end up being a major percentage of the present value of the property. The actual calculation of that becomes a very interesting area. There are many cases of partial interest. For instance, a rent may be set a little above or a little below the true market value. When the market is set a little below market value, we speak of the tenant as enjoying what's called a profit rent. And that is the benefit to the tenant of paying below market. In the example of the peppercorn rent that I spoke of earlier, the profit rent to the tenant is virtually the entire rental value of the property. Usually the profit rents are considerably lower than this. There also can be a loss rent in the case where, for whatever reason, a rent is struck above the true market value. And sometimes these happen in cases where the market is in a certain case of turbulence, and for whatever reason rents and leases are set either above or below the market. Other cases, other common cases, is the case of where for various reasons the land is rented to a tenant who proceeds to develop the land, maybe puts an office building or some other valuable investment property, investment building on the land, and then proceeds to rent the whole thing. In these cases, we often talk of a ground rent, and the ground rent is the rent simply on the land, whereas the investor is earning the rent for the developed property. So they're seen as being able to manage the property and find tenants for their development. From the investor's point of view, they have the opportunity to use the land for the economic life of the building, and so they're looking for a financial return adequate to be able to pay for their capital investment in the building. In practice, often ground leases are set over the economic life or the expected economic life of the building, with the reversion of the building to the landowner. What this means is that if you were to rent the land, say in a CBD area, from some landowner, you might construct a building that you consider to have an economic life of 30 years. You will expect to be able to earn sufficient rent from that developed property so that by the time you earn your rent from your tenants who are occupying the developed property, and then pay your ground rent, the net difference that you earn, which is the difference between the developed property rent and the ground rent, will be sufficient to be able to give you a reasonable rate of return on your investment in the building. And at the end of the 30 years, the economic life of the building, you're happy to walk away from it. The landowner inherits a 30-year-old commercial building, which from their point of view may not be that valuable, and everyone's happy. These relationships of having a separate builder and developer investor actually develop land which belongs to somebody else are fairly common in CBD areas and are often used when the government owns valuable real estate that it wants to maintain some level of long-term control over. The calculation of these is a specialised area of partial interests that we'll also be looking at. What I intend to do now is work through a simple example of partial interests using a Excel self-correcting exercise. You'll find that this self-correcting exercise has many worksheets. I'm only going to work through one. I'll leave you to work through the remainder of them. Turning now to our example. Here we have a simple partial interest problem, and we're going to solve it by building ourselves a small discounted cash flow model. Here we have our model where we're going to be writing out the values or computing the values for the market rent, face rent, profit rent, and eventually discounting that back to the lessee's interest. To begin with, we're going to put up the period numbers. We have a 5-year lease, so we only need to go up to 5 years. Because from the point of view of the lessee, that's the only set of cash flows they're going to be earning. Now in the example here, we have our rent, which is $215 per week, and we have no provision for adjustment, and so we have a face rent of 215. Let's do an equation. Equals 215 multiplied by the 52.2 years. So we have $11,223 in the first year. We said that there's no adjustments in the lease, and so our rents are going to be the same value all the way through. The market rent, however, starts at $285 per week, and so in annual terms that's $14,877. In the second year, this first year value is going to increase by a factor which is 1 plus the market growth rate, 15,323, and that growth, we're going to come up here and I'm going to put some absolutes in there. This enables me to copy my equation across, and so now I have my market rent increasing, my face rent is constant, and so I can work out my profit rent as the difference between these two. Again, I copy that equation across. Notice that as I insert correct equation or value, the yellow highlight disappears. I'm working on a discount rate to the lessee of 13%. And be wary, because lessees and lessors are very likely to have different discount rates. You need to consider the risks that they both are taking on. I'm going to calculate that as 1 plus the lessee's discount rate, absolute that, close brackets, raised to the minus year power. Notice I use the negative in front of the exponent here because that gives us the reciprocal. That's our discount factor. Spread those across. I work out my present values as the future value multiplied by the discount rate. Again, fill those across. And now here I'm going to sum the profit rents. And so it means that in this particular example, the lessee has a partial interest in the property amounting to $15,000, $15,689. What that means is that because the tenant is paying less rent than they should, in this case that lower rent is getting lower and lower relative to the market rent each year, the lessee actually kind of has a financial interest in the property regardless of whatever else they do. When we come down and look at the lessor's interest, we have 0, 1, 1, so on. You look at the market rent. Market rent is worked out the same way. In fact, I'll just borrow the market rent from up there, spread that across. Now I'm going to do one additional year. In fact, I'm going to steal the mathematics here to do year 6. I'm not actually interested in these rents directly, but I'll show you the benefit of them shortly. The face rent that's being earned by the lessor is the face rent, and again we can borrow that from above, and we've got 5 years of that. We've got the reversionary value. What we're going to do here is capitalize the property's value from the following year of income. And we do that by taking the year following the last year of the lease, and we capitalise it by using the terminal cap rate, which is given at 9%. That gives us 191,000, and this means that the cash flow to the owner, the landowner, is simply equal to the face rent plus the reversionary value if it occurs, and we can spread that across. By the way, the owner doesn't have to sell the property in year 5. However, for the point of view of a discounted cash flow analysis, we have to assume that it's being sold, or at least that value is coming to the owner in year 5, which is what we often refer to as a notional sale. We use discount factor similar to the above, only this time we use the lessor's discount rate, 12% in this case, calculated similarly using the negative of the year number, fill that across, simply discount the future values by the discount factor, fill that across. I'm just going to believe there is a number in there. That number there is not visible because the column is too narrow to display the number to the precision in its formatting, and because we have a locked spreadsheet, we're not going to be able to change that. Let's see if we can change it now. No, we can't. Okay, and the lessor's interest is the same. It's the sum of these present values. Okay, which in this case is 149,191, and we've got the answers all coming out happily because we've got all of our yellow highlights go away. I'm not sure why the yellow highlight has remained in this year 6. I think we can disregard it because the capitalised value is correct, and we can see that the lessor's interest is also correct, so we can ignore that highlight. It must be a rounding error somewhere in the conditional somewhere. We can ignore that. Okay, so what do we have? We can see in this case the lessor, the property owner, has a interest in the property of 149,000. The tenant has an interest of 15,000, and so between the two of them, if we add these two together, these two partial interests being the only two, we can say that the property in total has a value which is the sum of these various partial interests. So in this case it's roughly 165,000 thereabouts. Okay, I'll leave it to you to go through the other examples. There also, towards the end, there's a simple ground rent diagram which looks at a cash flow diagram. We've introduced this before, but this one looks at the case of ground rents. Work through the examples. They are taken from real possibilities in the market, and while most of them use a compact DCF rather than a year-by-year DCF, basically the computations behind them are the same. When you do these exercises, please remember to check them with a financial calculator so that you're able to do these exercises, these models, without needing an Excel computer, and also so that you can reproduce these calculations and check similar calculations in the exam.